Okay, Assalamualaikum and good afternoon, ladies and gentlemen. Okay, my presentation is focusing on the Malaysian equity. I believe the previous speakers already touched a bit on Malaysia. So what I'm going to do, maybe I'm going to present on different angles. So my topic going to be how can we capitalize on the external drivers. Okay, this is agenda, overview, global market performance and market outlook. So before I begin, I would like to highlight 3 key points from my presentation. The first one is to look at the broader market. As you know, our market have underperformed for the past few years. But there were opportunities if you look at the broader market. Second is to pinpoint the key sectors that going to be favorable for this year. Third is to stay invested, as long-term outlook going to be positive and it's quite challenging to time the market. Okay, let's start with the global market performance. As you can see here, the S&P 500 and Nasdaq 100 have been the best performing indices. Despite of global manufacturing downturn, Nasdaq has recorded 31% return over 3 years. In 2023, Nasdaq surged by 54%, driven mainly by the technology AI-related stocks. Besides US, Japan also stood out last year with a return of 28% in 2023. Japan is at a turning point with fastest price recovery, signaling an end of its deflationary cycle. Okay, looking at the regional market performance, Taiwan emerged as the top performer in the region due to the strong recovery in semiconductor products. Meanwhile, China and Hong Kong are facing challenges with an economic slowdown and property crisis. And if you look at the ASEAN market, Malaysia surprisingly emerged as the best performing index year to date after lagging behind for the past few years. KSCI has recorded positive performance this year, but negative performance in the past few years. The same goes to the ABM Emas Sharia Index. Okay, so during this period, you guys may be wondering why invest in a market with negative performance. In my point number 1, take a look at the broader market. You see, small cap has relatively better return. You can see the 3 years return is 5%, 5 years return is 45%. But some people will say small cap is too volatile and high risk. That's why for me, I prefer to look at the broader market because not all mid or large cap stock underperform. Some might have even double or triple the return. The key is diversification, balanced portfolio with a high quality stock that are trading at attractive valuations. Okay, let me show you. If we break down the return by sectors, you could pinpoint which sectors that have generated more return in each particular year. By doing this, you will notice that our market is in fact external driven. Starting with the year 2020, during the pandemic year, where healthcare was the most important sector to the economy, has outperformed significantly, led of course, you know, the glove sectors. And then in 2021, the technology continued to perform as remote work became the norms, driving a boost in digital transformation effort. On top of that, there was chip shortages in the auto and consumer electronic products that have increased the earnings margin for these technology players. In 2022, there was the Ukraine and Russian conflict. Commodity price went up significantly, which have a positive impact to the oil and plantation companies. And last year, 2023, there was a significant development of data center in Malaysia, which led to the rally in properties and construction sectors. Other contributing factors include the Johor Singapore Economic Zone, as well as rapid adoptions of AI technology, which was why the reason data center is very important. And this year, the technology staged a comeback after 2 years of contraction caused by the inventory adjustment. Power sectors are expected to remain robust owing to the higher electricity demand from data center. Property and construction are still promising, with details emerging from Johor Singapore Economic Zone. And finally, the energy sector, which is heavily influenced by the geopolitical tensions as well as decisions made by the major oil players. Okay, so now you guys should be able to clearly understand which are the drivers for the market performance and the factors that contributed to this growth. There are so much opportunity we can capitalize on these external factors. Okay, the sectors that could benefit for this year or already have benefited for this year are the sectors that involve in these AI and data centers. I'm sure you guys know this pretty well, but let me just show you the value chain. We have chip designer, we have chip makers, we have server manufacturers, and 5G networking equipment that produce the component inside the server rack. And then we have the supporting companies that involve in the power management, testing and machine equipment, as well as facilities provider that cater for this data center environment. And most of our listed companies are involved in this mid to end stage of value chain. For the server manufacturing part, we have the company that do testing and packaging for AI chips. And then we have companies that produce this 5G networking equipment. And outside the rack, we have this power management company, mechanical and electrical contractors that connect the power source to data centers. Also, we have the companies that provide energy cooling solutions to contain the heat within data center. And at the bottom of value chain, we have data center provider. Typically, this company require a sizable land bank, and many have collaborated with the property players. That's why you can see that the sectors that have rallied year to date are property, construction, technology, industrial, as well as utilities. Because these sectors are more or less involved, more or less benefited from these AI and data centers for their future earnings growth. And for the rest of the year, we think this trend could sustain as there are still names that are undervalued and haven't been fully pricing in within this segment. Okay? So, the outlook. Many people have asked me whether the rally can the rally sustain for the rest of the year. So my answer to this is the recent shift towards this loosening monetary condition globally marks a critical inflection point for this financial market. The trend typically bodes well for this long-term market performance. Yes, we may have a correction. Factors like geopolitical tension or the US Fed data-dependent approach may create a short-term fluctuation to the market. For example, any strong job reports or any spike in the inflation may lead to the Fed maintaining higher rates. As you can see, the recent data shows that the inflation are trending down. But if you look at the chart, the core inflation is still above this US Federal Reserve target rate of 2%. That's why the consensus expectation earlier from 6 to 7 rate cuts has been reduced to just 1. For me, even if it's still 1 rate cut, this is still positive when the Fed actually cut the rates. Okay? And then, on the global economy, we observe common theme here. Last year, there was this global manufacturing downturn. But the global economy was supported by the strong domestic demand globally. And this year, we expect manufacturing to rebound, particularly on these technology and industrial sectors as production has normalized post this inventory adjustment. On the contrary, the global consumption is expected to weaken as household saving deteriorate. And then we have China. The country is still slowing down. If you look at this top left data, the manufacturing and services PMI has contracted recently due to this property downturns as well as weaker domestic consumption. But China is still poised to drive global growth. The country has substantial global savings that could support their domestic demand. Their export has improved, capturing the market shares from Western companies. The previous speaker also have mentioned about this. And then if you talk about this EV space, the Chinese EV companies has about 60% of global market shares. What they need to do is that they need to deploy a large-scale stimulus focusing on property sectors so that it can boost the confidence and drive the domestic demand higher. The risk that I foresee is the trade tension. The trade tension may escalate nearing to this US election. The Biden also has recently announced several tariffs on semiconductors, EV, solar cells, as well as medical products. And interestingly, the tariff on the medical product include the glove, which the effective date going to be in 2026. I don't know why they want to mention it now, but for the rest of item, the effective date is this year. So, nevertheless, the trade tension will be positive for this player outside China, as we can see more trade diversion into this region. Okay? Okay, if you recall, my final point, stay invested, as loosening monetary conditions globally would eventually be positive for the financial market. Of course, we're going to have a noises of correction along the way, but that will provide us the opportunity to collect at a lower price. And for my final part of my presentation, I want to talk a bit about this Malaysian economy. We could expect more trade diversion into this region as part of the China Plus One initiative. And if you look at the top left chart here, you will be surprised that the labor cost in China is triple of what we have in Southeast Asian companies, prompting many companies to divert their production here, not just because of the trade tensions. The foreign direct investment has also improved in recent years, and the currency also has stabilized after the worst currency we faced last year, partly due to this political stability and more announcements by the government, such as National Energy Transformation Program, as well as the Johor Singapore Economic Zone. And our foreign flow is still at the lowest. It's still at the lowest point because more money is flowing to the Korea and Taiwan, as both countries are the main semiconductor players in the region. And finally, our valuations in terms of price to earnings is still hovering around this average line. You can see the white color. So there will be more upside still for our markets. And strategy, we remain positive on technology, growth, high beta stocks, and we balance it with this low beta and consumer stocks. Okay. Yeah. Okay, just a bit on our funds. We have this CAF Dana Dip and CAF Islamic Dividend Income. CAF Islamic Dividend Income is the recommended funds by the fund supermarket. Okay, you can see that our returns have consistently outperforming the benchmark since 2020. And we have recorded almost a double-digit return every year. So that's all about my presentations. Thank you for your attention. I hope I give you insightful knowledge on this Malaysian equities. Thank you very much.